Okay, so what we've got, I think we've got a special treat right now. The very first deal between a large bank and a peer-to-peer lending platform was the Barclays investment in Rainfin. So we have Eugene Boyson from Barclays and Sean Emery from Rainfin up here right now. And what we're going to do is we're going to ask some questions and then we're going to open it up. I'm going to ask some questions and then we're going to open it up to the audience in a few minutes. So the first question I actually want to have for you, Eugene, I mean, Barclays is one of the top 10 largest banks in the world. How does peer-to-peer lending get on your radar?
So actually, for me, it started a journey in San Francisco. I was at Singularity about 1.5 years ago and got exposed at that point to two peer-to-peer lenders, one crowdfunder, the other one Indiegogo, and just got exposed to the model, heard what they were doing, and very quickly realized we're actually looking at a mega trend here. And the more we analyzed the model, the more we took it apart, we very quickly realized we're dealing with something that puts Moore's law into banking, and it's going to scale faster than we think it's going to scale. And invariably, we realized we could participate as lenders onto that platform, or ultimately we could get involved as equity players and potentially then become more agnostic to who's involved on the platform and who's playing. And that kind of set it off in motion and got us involved and set off the beauty parade to go find suitors.
So then when you came back from San Francisco, you obviously did some more research. You're based in South Africa. You obviously then found out pretty quickly about Rainfin, I imagine.
Yeah, so I was going to say we kissed quite a few frogs before we found the prince. But no, it was more around trying to find people who thought the same as we did around what we thought peer-to-peer could do and how it could scale. And more importantly, we weren't just looking at the retail market, we were looking at a corporate investment bank perspective. So we were looking for someone who had a very similar mindset around it and the target market they wanted to attract. Interesting ideas around how to tackle the enterprise lending market, how to tackle the supply chain. And those are the ones that really resonated with us. It clicked better with our customer base and clicked better where we want to distribute our funding.
Okay, so let's just go over to you, Sean, then. Why would you choose to go partner with a bank than go to get, well, everyone else in this space goes to the VC market, private equity. Why partner with a bank?
I mean, it's a question I get a lot, right? And it's something which we think about regularly. And I think when you've got an industry which is ultimately starting and it's flourishing, and you want to build your business to the big scale that you can, there's a lot of people who would provide you with just funding, and provide you with some equity capital, and then sit on the sidelines and watch what happens to your business. But we felt we really needed a partner. We needed a partner that could help us grow the business. And we think about, I mean, if you are an individual and you're starting a new business and you look at your friend in the eye and you say, should we do a business together? What have you got? What have we got? And how can we grow this business? And when I started having a conversation with Barclays, they at least saw it in that way, right? Barclays Africa had a view about what they could bring to the party and what we could bring. And it was much less of a conversation around what is the valuation, what's the equity return that we can get, and are we going to get out of this in the future, which is a lot of the conversations I was having with VCs were much more in that line, when's the exit, when's the IPO, these kind of conversations. For them, it was not about that. It was about, in the next 20 years, how is banking going to change, and will peer-to-peer lending be a core part of our transition? And can we walk that journey? So the partnership just fitted in that context.
Okay. So then, can you explain how you go through the process? I mean, obviously, this is not a deal that got done in 30 days. Firstly, let's just go back to when you guys first chatted. Can you tell us about that, and then the process that came up to the consummation of the deal?
I mean, the deal in our context, I met the first person in sort of their business unit, a guy called Johan Locke. I met him 363 days before we closed the transaction.
Interesting. Okay.
So in that context, yes, it's not an easy thing doing a deal with a business that ultimately treats every deal they do as if it is $1 billion transaction.
Right.
We're not that size of a transaction, clearly. But the structures that you have to go through, we felt, well, is this years worth of time worth kind of holding back, waiting? Because technically our business had to go into a lockdown period, really, because you have to evaluate every aspect of the business, for the regulatory aspect, the security aspects, the money laundering aspects, the risk aspects, and all of those things take so much energy of the team that you work, our team, because obviously our team is small in this context, and you're working with a big organization with a lot of people. So it was very difficult in that one. I mean, it's not something you would do lightly. It's much easier to go and get a VC fund to invest in your business and just take a stake from them. But you don't get any of the other operational benefits.
Right. And actually, and Eugene, over to you. I wanted to, ask you what. I mean, obviously, as Sean said, this wasn't a $1 billion transaction. Your bank is obviously a very large bank. This doesn't even measure as a blip on your radar. Why do a deal that's so small?
I think it's one of those that looks small now, but I think fast forward and kind of see where you think the business goes and where it scales. I think it's one of those, we're all familiar with the Morris Law. I think we overestimate the impact of technology in the short end and we underestimate it in the longer term.
Right.
And I think this is a classic example of that occurring. So we definitely see a different scale with this business when we fast forward through time. And all the investments we do in the space, we look with at least a minimum of a 2020 horizon in terms of what these businesses look like and where they go. I also think we realize there's a deep learning that's going to happen here. No doubt about it. I think even when you look at the current lending environment, how much has been done on these platforms, I think it's a blip relative to the global size and what lending looks like on a global scale. And I think there's still a big transition, a big knowledge base we have to garner and learn and experience. And I think some of those lessons are only going to come from experience and being part of the process. So for us, this is it's a ticket into something bigger. And it's a ticket with a partner who's there with us. And we get the ability to grow, size, and understand.
Okay, so then on that note, then, you mentioned the year 2020, which is obviously only 6 years away now. What is your vision? Where do you think this will be, either in South Africa or globally? Where do you think this industry is going in 6 years?
So if we look at least 2018, just in South Africa, we probably see for ourselves about 8 to 10 billion, and that's being relatively conservative. When we look at the sector we really like in terms of the supply chain, we see it as something pretty big. It's big in terms of our clients. Our current ability to tap into that lending is really poor. It's not somewhere we function effectively. When we look at what it does in terms of the context of Africa and scaling these small businesses and creating access to finance, the proposition looks a lot more endearing. It definitely has more of a double bottom line impact that we definitely could do with. And I think it augments. One of the speakers earlier spoke around when is it that peer-to-peer is doing really well, and it's when it's probably not competing with any bank product. And we're already seeing it now in the Grameen type models, in the Stokvel type models, which are community-based lending, in the SME sector, specifically supply chain, some of the enterprise development, the potential's there, and it's where we're not playing as a bank, and it augments really well with that. And then I think it's just looking at what it does as this model scales and exponential. I think it takes bigger and bigger chunks of conventional banking business.
I'll tell you, Peter, that was one of the interesting things for me about when things changed in the deal process. And I think when we sat down and we mapped out the future of where's 2020 going to go, or 2024, and I started looking at the picture with them to say, right, there is clearly an unsecured lending market for 6 months to 12-month loans. Then you have your secured markets and you have the supply chain markets. And when you go through all of the various products that could be there, there was then the realization that actually it becomes a core competency of an investment bank is to manage this process through all of it, because it could actually affect every aspect of the business. So it's best to understand it when it is as small as it is, so that you can know how you can scale it when it gets a bit bigger in that context.
Right, okay. So let's switch gears to investment and when we chatted earlier, you were saying that getting investors on your platform initially was a real challenge. So what does this deal do for you as far as attracting investors?
Well, I mean, I just loved the presentation that was before, the one before we came on. We had all the institutions here and all the investors,
right,
and all the questions that they were posing out there. I mean, I think every platform that is out there at the moment has the same issues when they go and talk to an institution. And I think this is an industry which has a perceived very low barriers to entry. So we've got a whole lot of new entrants that are entering the market, and they're taking little slices, but guys are getting together and they're building their space. But when you want to scale to get to the, in the billions of markets, and you want to start having big institutions give you big slices of their capital, every single one comes in and starts with a checklist, which starts off with, what is your model? How long have you been in business? Do you have a 20-year track record of your credit scorecard? Do you have the ability to originate loans in all of these sectors? Am I going to lose money if you fall off the ocean? What's going to happen to us? How are we protected from your bankruptcy, or how are we protected from the bankruptcy? So what are your regulations in place? Have you tested the market from a regulator point of view? What's going to happen in 6 years' time? When you do 365 days of due diligence, okay, you have to answer a lot of these questions, and you spend time with it. So what it did enable us to do was build a very good deck and a very good understanding of our business, much before we had the problems necessarily of all the operational issues that we were faced. A very good investor pack and IM pack that we can take to these guys. And of course that helps, but I mean, we have a halo effect of obviously having a partner who also watches us very carefully to what we do. They don't control, course, but they watch very carefully what we do. And there's a lot of intellectual property that we have now on our board, in our business, in our operational partnerships, which can help us to make sure we don't make emerging company mistakes. They've been in all of these markets for over 100 years. They understand what credit scorecards should be. They understand what risk should be. And so that's very important aspects that we can now learn from.
Right. Okay, I'd be happy to open it up to questions from the audience. We have the runners on the side here. Let me see, I should probably stand up, shouldn't I? Anyone?
I'm just curious from the Barclays perspective. I know we talked about this becoming a bigger part of the banking industry. How does this change your distribution model, how you interact with customers, maybe not in 10 years, but 15, 20?
So it's hard to say what it's going to look like 20 years from now, but I think you want to evolve with the model. And I think the only way to do it is to go along with it on that journey. I think it takes you over the wall, and you get to see what the potential problems are and what the potential opportunities are. I think it allows you to grow the model alongside the client. I think the ability for the platforms in terms of access to clients, for us, access to distribution channels becomes really important. But in terms of this transaction, we are still a minority partner in the arrangement, and it's still Rainfin who's face out there and largely responsible for the client experience. All we can do is look at some of the lessons we've learned and apply those, and actually trust these models to change that underlying experience for us. Because what we're definitely not doing well right now is in terms of how we're dealing with those clients. I think the patterns of consumers have changed, how they want to interact with their financial institutions and what those institutions need to look like. And peer-to-peer is beginning to do that. And if I fast forward 20 years from now, I think it was Ash who said earlier, are banks still going to be around? And he felt not. And he may be right, to the extent that do I think they'll be around? Probably yes. Do I think they'll be smaller than that right now? Highly likely. Do I think there'll be competition and different faces in terms of what faces off to consumers and clients? Yes. And will they still be providing products? Probably, but a lot smaller subset. I think it's very similar to the record industry and the music industry. I think the music industry is thriving. Maybe the record industry isn't. And I think you're going to have the same thing related to banks. I think finance will be thriving, but maybe banks not doing as well.
Interesting, coming from a banker. So, on that note, is there any interest in other countries? Like Barclays, obviously a huge global player. Do you know of any other areas of Barclays that are looking at this seriously?
I don't know if they're looking at it seriously. I know they're looking at us seriously.
Right.
So I think it is an opportunity for them as well to get a deep understanding of this business. We've got a presence in 12 countries in Africa. We're currently just in South Africa, and we're looking to grow it out into the other areas. And then we have 2 presence countries. We run rep offices in Nigeria and Namibia. And peer-to-peer, again, becomes an easier platform to go into these frontier markets where you don't necessarily do a bricks and mortar build,
Right.
but you can still provide a level of finance, maybe similar to Banco Santander and their entry into the US. So it does open frontier opportunities a lot quicker.
Right.
So I think 3 to 5 years down the line, is it a global opportunity? I think that largely depends on how this transaction goes and what we learn and the success of it.
Yep, okay. Another question? No? Okay, well, there's one over there, yep.
I'm sorry to repeat a question that was asked earlier, but may I get the answer from a banker's perspective? With regard to synthetic currencies like Bitcoin, what is your perspective on that, and where do you see that going from a banker's perspective?
So a banker's perspective also has its origins in currency trading. I think the cryptocurrencies are an interesting phenomenon. If you look at probably just the Bitcoin example, I think the volatility and at some point the need for people to materialize it into something makes it tough. I'm not sure around their ability to grow and how effective they are going to be. I think it will lower the cost of being involved in the price mechanism if one was established. But I do worry if it doesn't expose us to a fragility by having a singular currency. For me, the more interesting thing around the currencies that are of interest to me is probably the evolution of virtual currency around our identities. I think people are moving into the point where there's 2 personas, our analog persona, physical persona, and what's transacting in the virtual space. And I think the ownership around those virtual personas are going to become the real valuable currency we transition to. And I think as we move to these digital economies and virtual economies, that becomes more and more important. And I think the value of banks in that perspective around vaults, around that digital persona, becomes maybe their point of relevance 15 to 20 years down the line. And more so than maybe the value of any cryptocurrency or a mechanism of exchange.
So Sean, just one question I really wanted to get before we go out there is how you had your scorecard and you had your underwriting model in place before you went out to Barclays. Now you've got this 100 years of experience of underwriting credit. How have you adapted, and have you been surprised by what you've learned in this process from a credit perspective?
Very much so. A core part of the due diligence of our organization from an acquisition point of view is the algorithm, right? It's a cool part of the asset of any of these peer-to-peer places. And to open that up to a bank as a shareholder, there were 2 divisions clearly. There's obviously a Chinese wall. They have their scorecards. We have our scorecards. Mm-hmm. And in order for us to be able to have lots of synergy in the funding and synergy in operations, we needed to at least make sure that our scorecard had some ability to track towards theirs was. But we can then build on what they have got with a lot of other additional data sources, which are perhaps easier for us to source in. I mean, I think it's much easier for us to start bringing in very, big data, big social elements into the scorecards, which traditionally weren't there on the 100-year-old scorecard. That makes sense. I personally think we're enhancing what they might be doing. Mm-hmm. In essence, but it is interesting for me then to be able to call on a credit guy who's been there for 25 years, ask him to come into our business and give us some advice on our scorecard. They can't tell us what their algorithm is, but he can sure point out the holes that there might be in ours. Mm-hmm. So it's very, very interesting to be able to have them do stress testing with us, able for them to actually do back testing for us to go through. We didn't necessarily have as much data as they would have had inside the organization. We don't have the data that sits there, but they can point out to us areas where we could enhance it, areas where we think that it applies specifically to SME. I mean, I think something which was quite flippant that we went over is that, Rainfin actually has its history in an SME-based lending model. I mean, it's very interesting for us. Yes, at the moment our service now is live with a consumer-based process, but we are very, very focused on what Eugene calls the supply chain market. You know, we think that there's a huge hole in that market from a funding point of view inside the whole of Africa, and obviously it applies to all the business models that are here as well. So to work with them on that has been very interesting as well. Work on a greenfield scorecarding ultimately with them, which has been interesting.
Interesting. Okay, so we have time for one more question from the audience. Anybody? No? Okay, I got one more then.
There's someone
if
over
no
there.
one's,
Oh, someone over here? Okay, good.
I would have asked a question, Peter, which is, I saw the headline, which was "A wolf in sheep's clothing," and I have to ask, based on people's projections on where banks are 20 years from now, and where they see peer-to-peer going, who do they think's the wolf in this transaction?
We actually need to hand over to Sean. Sean suggested this as a title, so who?
No, you can't tell them that.
Who is the wolf? Who is the wolf, Sean?
Well, it was interesting. You know, we've had a lot of. When you have a deal like this, ultimately you have to go eventually and talk to lots of other people inside the organization who are not involved in the whole deal structure. They don't know what we were doing. They don't understand the strategy behind it, but you go and then start communicating. And you have some very interesting conversations with people. You know, somebody who is necessarily head of the retail division of a bank potentially might look at it a bit differently to someone who's the head of the investment banking division or the head of the fund management division. They could both see this in two completely different lights. In that context. So some people think we're the wolf, and for other people we're the sheep.
I know, so let's leave that question unanswered, shall we?
Yeah, so we have two hats all the time, yeah.
Exactly. Okay, so we have one last question.
Yes. I was just interested to hear what, perhaps, Eugene, what your competitors are saying about your involvement in this particular industry. Have you had the opportunity to talk to your competitors, and what's their reaction been?
Yes, surprisingly, I didn't do too much talking to the competitors. So it's hard for me to really give a view. I think a lot of them saw it now as a call to action. I think a lot of them are looking at it a little bit more seriously in terms of what are the ramifications and what does it mean. But I think the bit that did surprise me was less what our competitors thought and actually what amounted to a large degree of upswell support within the firm itself. And I'm going to say a massive amount of support from what I'd say is our Generation Y, just in terms of what it meant. And that degree of social resonance just was something that was wholly unexpected. And I think also gave us a huge amount of confidence around the transaction itself. And I think to an extent that same dynamic in our competitors are the ones who've taken more note of it and at least spoken out around it.
I can address that to some degree. That it was very important the way the deal is structured. I mean, 49% that they acquired is a very specific number, and it's a number, and we also have an arrangement that we need to keep our business as independent as possible so we can still encourage investment from multiple other places. Eugene keeps on saying to me he'd like nothing better than the 4 other banks in the organization to use this to also deploy. So we have an internal mandate in that context to go and still make sure that our platform is able to attract funds and investment from the other organizations and the other banks. It's a very key performance indicator for us. That means keeping it still attractive to everyone in the marketplace.
Okay, well on that note, that's all we have time for. So thank you very much, gentlemen.
Thank you. Thank you, Peter.
Okay. Thanks, man. That was great.
Thanks so much.
Yeah, thanks, Eugene. That was really good. Okay.